Let's start with the next topic, that is factors affecting the working capital requirements. So first we will discuss what working capital is. Working capital is the investment which we make in current assets, or the or the assets which can be easily convertible into cash within a small period of time, short period of time, maybe of 1 year, right? Such current assets, they include our stock, inventories, our bills receivable, our debtors. So they all are a part of working capital, or you can say the current assets. Fine. Current assets, they indicate or they facilitate day-to-day operations of a business, right? They indicate, they facilitate day-to-day operations of any business, right? Before coming to the nature of business or the factors which affect working capital requirements, I would like to tell you that there is a word which is called operating cycle, right? Which is called operating cycle. The concept of operating cycle. What operating cycle is? Operating cycle means that the time period, it's a period between receiving the raw material and converting that raw material into a product, right, and getting cash out of the sale of that particular product, right? So converting the raw material into cash receivable, right, that is called the operating cycle, right? For any trading firm, right, a trading firm which is involved in buying the product and selling the product, right? So you will see that in a trading firm, the operating cycle is very short. They have a very short operating cycle. Whereas in a manufacturing firm means they are into buying the raw material, then the raw material will get through all the production process, fine, and then that particular finished product will be sold in the market, and then it will be converted into cash. So you will see that any manufacturing firm, it has a longer operating cycle, whereas a trading firm, it has a small or short operating cycle, right? So how operating cycle, that is related to the nature of business. Nature of business, trading firm. In trading firm, we have short operating cycle. Short operating cycle means it takes lesser time to convert the raw material into cash, right? And in manufacturing company, it takes longer period of time to convert raw material into cash or bills receivable or debtors, or collecting cash from debtors, right? So it has a longer operating cycle. Second is scale of operations. Scale of operations means the level at which a company operates. Fine. If a company is operating on a large scale business, then obviously the working capital requirement will be more, fine, because there is production on high level, so obviously for that they require more working capital, more cash in their hand. Production is higher and demand is higher, production is higher, and a company is on a very high level, or that's why they require more working capital. Whereas a small scale business, since the business is on lower level, so they require less working capital. Fine. Third is business cycle. Every business has a cycle. Fine. You will see a business, it establishes, it grows, it reaches to the saturation point, and then it declines. So there is a business cycle of every company. Fine. You will see when a company is at the boom, or you can say it's on its peak, or it's growing. Fine. So there you will see in that company, or for that company's product, there would be high demand, right? There would be high demand. Or you will see people, they are demanding more and more that particular product. So if demand is high in the market, then company is supposed to produce more. For producing more, the production has to be done on a large scale. If there is a high production, there would be high demand of raw material, fine. If there is a high demand of raw material, then obviously high working capital is required, fine. Whereas if a particular business is on slack, is having a slack period or a depression period or a declining period, then that particular company doesn't need high working capital, fine. Fourth is seasonal factor. You will see that there are certain business which has a seasonal cycle. Which has a seasonal cycle means that particular business, it functions in a particular season. It has a very, very small cycle of operation or operating cycle which is confined to or limited to a particular season. For example, you will see any company which is into the manufacturing of woolen wear, fine. So their company will on boom, or their company will grow, or their sale or their products will be in demand in the in winters only. There is a time limited, that is winters, fine. So they'll require more working capital in winters because demand for their product is generally high in winters, because in winters people, they demand woolen clothes. So in winters, particularly in winters, they will be requiring more working capital, fine. So in that way, how working capital requirement, it is affected by the seasonal factors. Fifth one is production cycle. Now comes the production cycle. Every product undergoes, various production process, various production phases, fine. So a production is basically what? Production is converting input into output, converting raw material into finished good or finished product. That is called production. So you will see that every product, before becoming a finished product, right, there are various stages which it has to pass through, right? You will see that all products, different products, they have different production cycle, fine. Some product, they have shorter or the small, shorter production cycle, and whereas some products, they have longer production cycle. For example, there is a company which is into manufacturing of cars. So obviously car will have a longer production cycle, whereas a company which is into manufacturing of cycle, they will be having less, shorter production cycle. Therefore, they will be requiring those particular companies which are into manufacturing of cycles, they will be requiring lesser working capital in comparison with a company which is into the manufacturing of a car, right? Now, sixth point, that is credit allowed. If a company sells goods on credit, fine, if a company sells goods on credit and gives long period of payment to the debtors, right, such companies, they require more working capital, because the period between providing goods to, selling goods to the debtors, and and when they'll give you the payment back, the period is really very long, fine. Product and cash. So the period between converting the product, the finished product, into cash, right, the cash which we are going to receive from the debtors, that is long. So meanwhile, we will be requiring more working capital to invest for further production, right. Whereas the companies which provide goods on credit,